In Australia, trusts are commonly used for property management and tax planning. Today, let's look at what a trust is. A trust is essentially a legal document that outlines the purpose of the trust and the roles involved. One party, known as the settlor, transfers property to another, known as the trustee, who manages it for a third party, the beneficiary. It's like a safety deposit box for your assets, meticulously managed by a trusted individual or a company for the benefit of your loved ones. In practice, the settlor is usually your lawyer, accountant, or a friend, and does not play other roles after the trust is established. Common types of trusts in Australia include family trusts, unit trusts, and hybrid trusts, each with its specific use and advantage. Family trusts are often used for business and investments within a family. It's important to note that the beneficiaries of a trust must be family members. A family trust is the most flexible type of trust and can help distribute income to reduce the overall tax burden. For example, if a family's annual income is 400,000 AUD, distributing it evenly through a family trust to 4 people would mean each person only receives 100,000 AUD, thereby avoiding Australia's highest tax rate. The more family members there are to distribute income to, the more advantageous the family trust. However, if a family only consists of a couple and their children with no other members, is there still a need to establish a family trust? The answer is yes, it can still be very useful. For instance, if you have 100,000 AUD in investment income to distribute this year, but if the husband has an annual income of 200,000 AUD and the wife has no income, the husband's 50,000 AUD would be taxed at the highest rate. If the investment is held by a trust, then you can choose to distribute the full 100,000 AUD to the wife, avoiding the highest tax for the husband. Therefore, even if there are only 2 family members, the trust can still play a flexible role in income distribution among members. Think of income as water flowing into different buckets. A trust is like a diverter, directing the water into different buckets based on the need. This way, the final tax is determined by the amount of water or income in each person's bucket for that year. But a family trust isn't just about tax planning. It's also a powerful tool for asset protection. Since the assets are held separately from the individual, it's much harder for creditors to pursue debts, offering an extra layer of protection against lawsuits and claims. Consider the trustee as the guardian of your family trust. This can be an individual or a company. A corporate trustee offers stronger protection and better asset management. Plus, it eases the process of passing down trust assets in the future. Therefore, in practice, we generally only recommend establishing a corporate trustee. The appointor in the trust can control the appointment of the trustee. This role actually has the ultimate control of the trust. If the trustee cannot effectively execute the original intent of the trust, the appointor can change the daily control of the trust by replacing the trustee. When establishing a trust, the role of the appointor is often overlooked. In fact, this is a role worth considering. The appointor is usually yourself, or you and your spouse together. Of course, you can also appoint your most trusted friend, accountant, or lawyer to co-hold with you. Make sure that in case you are incapacitated, the appointer you choose will maintain the trust's original intent according to your ideas. Before we end today's discussion, we want to emphasize that the use of trust can be quite complex and needs to be tailored according to the specific situation of an individual or family. Thank you for watching.